Hello, and welcome to the Long-Term Investing Podcast with Baskin Wealth Management. I'm Barry Schwartz, Chief Investment Officer. Baskin Wealth Management is an independently owned investment management firm with over $2 billion in assets under management, providing customized wealth management solutions and services to families and foundations. In this podcast, we ignore all the noise and have conversations that make sense about the things that matter in today's markets. It's what we talk about with each other here in the office, and we want to share those conversations with you. Please stay tuned for our legal disclaimer at the end of the episode. We're back on the podcast. Thank you so much for joining us. Long-Term Investing Podcast with Baskin Wealth. We have a lot of awesome things to talk about, Ernest. Today, we're going to talk about currencies. We're going to talk about interest rates. We're going to talk a little bit about bonds. And then our feature discussion is a quick rundown on some of the earnings that our stocks have had, our companies have had. But before that, if you like this podcast, please subscribe to us on YouTube, on Spotify, on Apple. Please like us on YouTube. Please give us reviews on Spotify and Apple, preferably 5-star. That would be great. And we'll keep doing this podcast for you. So let's get into it. Ernest.
So apparently YouTube podcasts are a big thing now.
Huge. And didn't we just read that Netflix might get into the podcast game?
Yep. And more people are watching podcasts instead of just listening to it in the car.
Maybe we'll quit our jobs as portfolio managers and get rich hosting and doing podcasts. What do you think?
Maybe one day.
Anyways, for now, we love what we do, and it's so awesome that you could join us. And we want to talk, some interesting things have been going on. I'm done talking about tariffs. I don't know about you.
Well, aren't there aluminum tariffs now?
Yes, there's aluminum tariffs and steel tariffs. The good thing for the TSX is I don't think there's very many companies in Canada anymore that are publicly traded that are aluminum or steel.
There are.
Yeah, but not to the same degree. It used to be like an Alcan or a lot of the steel companies out of Hamilton. They don't really exist as publicly traded companies anymore.
Yeah, so this one I don't really understand from the American perspective.
Yeah.
Because it really doesn't seem that tariffing Canadian aluminum helps you achieve your domestic manufacturing goals.
Yeah.
Or increasing, like U.S. jobs for manufacturing. Mm-hmm. So I'm not really sure what the strategy is there.
I think our partner David Baskin said that this may create 2,000 jobs in the U.S., but then hurt 100,000 secondary jobs that are related and could be hurt by the fact of those prices of steel and aluminum going up by 25% or what have you. So I don't know how it's all going to play out. Hopefully, it won't last very long.
Was almost tariffed the first time, I think.
Yeah.
And Trump in Trump's first term, he actually pulled back on it.
So have these tariffs been stamped into duty yet, or is it still threats?
I'm not sure, actually.
There's going to be a lot of uncertainty. In the next few years, we're going to be dealing with a lot of unbelievable stuff. But in the meantime, Canada, as you know, has been dealing with a lot of concerns. A, the economy is not doing as well as the U.S. economy. B, obviously worries about tariffs and interest rates are way too high in Canada. So as a result, the Canadian dollar is trading around 70 cents today.
Under
70 cents. And it's probably the lowest it's been in 8 years.
Yeah.
And at one point when the day that Trump announced that there would be 25% tariffs on all goods, I think the Canadian dollar fell to its lowest level in over a decade, well below 69 cents. Since recovered, the Canadian dollar's actually up for since the beginning of the year, but it's been trending down from the high 70-cent range for the last 10 years to below 70 cents. So a lot of clients may ask us, and certainly the strategy is, okay, the Canadian dollar is going down. You own a lot of U.S. stocks. What happens if that reverses, Ernest?
Well, I think certainly you're going to see some degree of loss on the portfolio statement from the stock. But I think from a fundamental perspective, there's less reason to be concerned about these companies because a lot of the companies that we own, these are large multinational businesses with businesses all around the world. Like, so to the degree that the US dollar is weakening, they would benefit from their international businesses. So like Apple, for instance, would, if they're selling iPhones in Canada and in Europe or in other places, they would be making more money than in a regime where the US dollar was weakening.
And all things being equal, Apple would have higher profits and maybe the valuation and the stock price would rise as a result of the US dollar weakening against the Canadian dollar.
Yes.
But there's no guarantee just because the Canadian dollar goes up doesn't mean it necessarily the US dollar weakens, right? There's a lot of variables.
Right.
Yeah.
No, I think the main reason for the US dollar or the weak Canadian dollar is more that it's more due to pessimism about the Canadian economy, as well as rates, which we're going to talk about in a little bit. But I think these are not things that people are generally able to predict with any reasonable certainty, and we just try not to. We try not to make too many changes based on these kinds of things.
For sure. The currency can be likened to the stock price of a country, and the Canadian dollar stock price is not going in the right direction. And as a result, and we're going to get to it, interest rates in Canada are lower than the United States. So money tends to flow to the countries that have the highest interest rates, as long as there's not, crazy inflation and a stable government and, the ability to print money. And so that's why the US dollar is strong, that's why US interest rates are stronger. So it is a tough time for Canada. We will just continue to own the best companies wherever we can find them. We'd love to own more Canadian names. Why not? I'd love to convert more US dollars into Canadian dollars at these prices, but they're not giving away the great ones at reasonable prices, right? They're the names that we currently don't own in Canada. It's not like they're cheap bargains.
No, and I think that's I think that's really the point, is that I think the names that are the high quality companies today, like, they're not trading at like 10 times earnings. They're trading in many cases at even higher valuations than what comparable U.S. companies are trading at. So
for sure.
I'm thinking of names like Dollarama,
Dollarama or Descartes Group,
Shopify,
RB Global.
Yeah.
So these are some Canadian great businesses. We don't currently own them at the moment, but we can find as good or better businesses elsewhere and maybe even at cheaper valuations.
No, and I think the important point is that for a lot of these businesses, I think the FX has helped them because they have a lot of major businesses in the US.
Absolutely.
Shopify, for instance, has a huge US business.
It's all US, right?
Yeah. So to the degree that reverses, like you won't, if you're looking at your portfolio statement, then you'll think it'll look relatively better off relative to US stocks, but that is offset by the fundamentals at the business.
So the only really way to play it would be is if you think you buy a pure domestic company in Canada. But some of those pure domestic companies like a Rogers or a Bell or a TELUS, we don't want to own them.
Right.
Yeah.
So I think that's for a different time.
Yeah, for a different. So the currency risk is going to be, it's tangible, but it's also intangible. You can't see it, but you will see it in the results of those companies, right? So Canadian companies that do a lot of business in the US, they're loving the fact that the Canadian dollar is going down, as long as there's no tariffs on their products. But at the end of the day, the Canadian dollar can go up against that and it won't be as good for their stock prices. So very hard to play it. That's why we try to ignore the day-to-day movements of currencies. And as I said before, own the best businesses wherever we can find them and we're comfortable owning them. So going along with currency is interest rates, right? And so the difference between the U.S. treasuries or government bonds versus Canadian bonds is quite large. And I think, did you say the spread is the highest it's been in a long time?
Highest since 1998.
That's pretty long. And so what we mean by the spread is that's the difference between what a 5-year government of U.S. bond is paying versus a 5-year Canada government of bond paying. All things being equal, those should be considered risk-free assets. You hope your government doesn't go bankrupt or the country doesn't go bankrupt. So pretty much the return that those bonds are giving you are as good as gold. But the bottom line is the 5-year U.S. bond is paying what, 4.5%?
Yeah, I have that here.
Yeah.
So the U.S. 5-year is 4.49
Yeah.
as of like 30 minutes ago.
Okay.
And the 5-year Canada is 2.87.
30 minutes ago, and we're recording this on February 12th.
Yep.
After the U.S. reported a hotter than expected inflation number, and so many now expect the U.S. to be doing fewer interest rate cuts over the next year. So as a result, U.S. interest rates are higher than Canadian interest rates.
And this, I think, more than anything else,
Yeah.
has been really the driver of the weak Canadian dollar. Because if you can invest in one bond that pays 4.5% and one that gives you 2.8%, then of course you're going to buy the one that pays you 4.5%.
Correct. Of course, though, the risk that you have is the currency.
Yes.
Right. So you be maybe laughing, it's free money. I can get 4.5% on U.S. bonds versus my 2.8 on Canadian bonds. For sure, I'll buy U.S. bonds. But if the currency moves up 5% or 10% against you, you can lose all the return that you were getting from that spread. Of course, if the Canadian dollar goes down, you're double juicing the return. So hard to know. We're going to explain to you what we're doing in our fixed income fund, the Baskin fixed income pool that we primarily buy fixed income for our clients. We're actually pretty pleased, Ernest, the results that it had in 2024 and 2023. Not so much in 2022, but that was a crazy year where interest rates spiked up. We stuck with our strategy of keeping our fixed income maturities quite short. I think our duration, so that means if our portfolio was to mature and we didn't do anything, it's about 3 years. So in 3 years, our entire portfolio comes due, give or take. And so that's our comfort level given where interest rates are. And we're hopeful, although it doesn't look like it, that as the bonds come due over the next few years, we might be able to get higher interest rates, but not looking like it.
Yeah, I think people should understand that the way that people generally invest in bonds is a little bit different from the way you invest in stocks. Because if you're buying a stock, you're like studying the products, you're studying the management, you're trying to see, am I going to make more money in like 3 years or 5 years, and are they kind of trending in the right direction?
Yeah.
For bonds, it's very different. Like the whole point of a bond is that you're lending somebody money and that you want your money back and the interest.
Yeah.
So you don't need to go in and study like every nuance of the business to understand its growth opportunities, like what the competitive landscape is like. What you care about is whether they're going to pay you your money back. And so our strategy for bonds is, so the way this works generally is that there's a whole ecosystem supported by companies like Moody's, which we own, and S&P 500, Standard & Poor's, that will rate bonds, and they'll give it like a credit rating, like AAA, AA, B, B+, something like that. And for those bonds, that essentially determines the risk and the interest rate that you're getting.
That's right.
And the bonds that we purchase generally are all what they call investment grade.
That is correct. We primarily purchase investment grade bonds, or bonds rated by Moody's or S&P Global, where they say that there's high certainty that you're going to get your money back plus all your interest.
Right.
Yeah.
And so that contrasts to the junk bond universe, which are what these companies would consider to be lower risk, and there's a higher chance that you're not getting your money back.
That's right. And with those lower risk bonds, there should be higher interest rates, so you need to be compensated. There's a new form of bonds people have been investing in called private credit or private debt, where they're lending money to non-investment grade companies, maybe not even publicly traded companies, where they're getting compensated with a much higher interest rate. But then there's risks in a bad market where you could lose all your money. We're not interested in doing that with fixed income. Our strategy, Ernest, is to say, we'll take on a little bit of risk and volatility with stock markets, but we don't want to do that with fixed income. We don't want to lose money with fixed income. We're not trying to do anything funky or risky. We're trying to use credit and analysis and to find good quality companies that are offering bonds at decent yields and use some judgment. We'll give some examples of some things that we've done to try and increase the yield without taking on much more risk. But we have no interest in buying crappy bonds at higher yields. It's just not our strategy.
Yes. So I think if you look at the list of the issuers that we have, like there's a reason that people like they'll look at the stocks and how much money you're making on each position.
Yeah.
But people don't do that for bonds because they don't, they generally kind of stay the same unless something bad's happening.
Yeah. Especially with our style is generally we don't trade bonds either. We tend to buy them and hold them to maturity. So we're at the end of the day, all we're hoping to get is the yield to maturity, the difference between what we paid for it and all the interest we're going to get and what the company's going to buy back the bond from you at. And right now, of course, because we talked about interest rates going down, bonds are less attractive than they were a year and a half ago. The new bonds today that we're buying, the types of bonds that we like, given the maturities, are yielding about 4% in Canada, a little higher in the US. And some bonds that we like to buy are now 3.5%. And so we don't love to stomach that, but that's the market we're in. And we're not going to take on risks to try and get better rates of return in fixed income.
Exactly. Yep.
So let's talk about some of the things that we did in our fixed income pool, so people can understand, what we're looking for. We know a company called Morguard very, very well, real estate Canadian conglomerate, very large company. Those that remember in 2022 when interest rates went up, lots of worries about commercial real estate, people working from home, what's the demand for office, just coming out of the pandemic. So hotel stays were down, shopping center visits were down. It wasn't a good environment for real estate companies. Morguard had debt coming due. We had owned Morguard debt for a number of years. The debt that we owned was paying 5%. Not bad considering where interest rates were when we bought it years ago. But this was a crunch now. And so Morguard had to offer this debt to the market at 9.5%. So generally we don't buy bonds with, where there's risk, but we know the company well. As Ernest said, we do research on the business, on the debt, on the balance sheet. And we had an opportunity to buy a company debt that we knew quite well at a very reasonable yield, and that's worked out quite well for our clients.
Right.
Yeah.
Yeah, and I think there's a lot of examples like that in our portfolio where, because we follow a lot of these companies, we have comfort that it's not going to default on its bond.
Yeah.
Or else the equity would be in a lot more trouble than that.
For sure. Another example is Parkland. Why don't you talk about the Parkland bonds that we own?
Yeah. So Parkland's a company that we followed. And we understand the assets that they have and the cash flow generation that they have and the general strategy that they have towards, reducing their debt right now. So the balance sheet's getting better. And it's still a pretty, things are not a bit volatile at the moment, but results are generally quite stable. And I think Parkland's not considered an investment grade issuer.
It is not. I think it's BB+. So investment grade is really what they call triple B, BBB rating or higher, and that's technically investment grade. When a company is below that, it's not considered investment grade and generally has to pay a higher interest rate to compensate you for buying its debt.
And because we're familiar with Parkland, then we felt comfortable buying the bond, even though it is not investment grade.
Yeah.
And that's another example of the types of things that we can do to increase returns in the bond pool without taking on the corresponding risk.
We also diversify largely in our fixed income pool. We try to limit position sizing to about 3% for bond weightings because we definitely, if a bond defaults, you never make that back. And it's not like you get any upside return from any of the other bonds that you own, especially if you hold them to maturity. All you get is the interest rates. So we don't want any bond that we own to defaults, and that's why we diversify and own a lot of them. Recently, for our clients, we started to buy a little bit of U.S. fixed income, very short, but we are taking on a little bit of currency risk, but we think we're being compensated well for the higher yields that these short-term bonds are paying. And it's a little hedge if things do worsen with the Canadian dollar. We haven't purchased enough either way to make a huge difference to help us or hurt us, but we thought it was a prudent decision to make for our portfolios.
Well said.
Anything else you want to talk about in terms of bonds? And thank you, those who love equities. The bond discussion is not always the most exciting, but it is an important part of our routine for clients. Not all of our clients own 100% equities, nor should they. I'm not going to lie and tell people that bonds are going to be a gigantic moneymaker for our clients going forward, but they're a nice way to dampen the volatility. And for those that can't sleep at night with equities, they may be an appropriate, suitable replacement or alternative or part of their diversified portfolio. And, we customize our portfolios based on what our clients are looking for, their goals and objectives. And as a result, fixed income definitely is an important part of many people's portfolios.
Yep. Well said.
All right. So what do you want to talk about? Some corporate earnings that we had last week?
We're right in the middle of earnings season. And this is for the fourth quarter of 2024.
Yeah.
So they're telling us what happened end of last year, usually October to December period.
Even though it's mid-February, companies are reporting their results from months ago.
Yeah, I mean, it takes time for them to, write the annual report and compile all the data together.
Yeah.
There's some companies that, I don't know if it's just because they want to showcase how sophisticated they are.
Yeah.
Like JP Morgan always reports in they always want to be like one of the first companies to report.
Yeah.
And
we own some companies that take their sweet time reporting, or companies like a Constellation Software that's happy to report its earnings on a Friday night, or Berkshire Hathaway will just report its earnings on a Saturday morning.
I'm surprised that more companies don't do that.
Yeah.
Because the rationale for Berkshire and Constellation to do this is that they think it's unfair that there's going to be a big market movement before people have even had a chance to digest what's going on.
Yeah.
And so that's why they release it on a Friday night, so that you have the whole weekend, if that's your thing, to really study and understand what's going on.
Yes. Well, so for those clients that don't follow, when companies report their earnings at 4 o'clock or 4:30 after the market closes, there's after hours trading. And within a millisecond of reporting earnings, stock prices will go up or down, multiples of percents. We recently had Google reporting its earnings. The headline number looks strong. The revenue looks strong. They beat expectations. And half a second after reporting earnings, the stock is down 6%. And you're like, why? What's going on? What do I know? Who knows this? Who's reacting to it? It's not gentlemen fund managers like us buying and selling after hours. It's algorithmic trading that is responding to specific data points that may have beaten or missed analyst expectations and trying to get ahead of what they think the stock market reaction will be the next day, right?
Yeah. I think that's essentially it.
And we don't play that game, by the way. We have no interest in it. If a stock we like falls 10 or 15 or 20% or what have you.
That would be bad.
That would be bad. It'd suck. But we'd use it as an opportunity if we thought the price fell way too much versus the value of the company. And we've had this before. It just happens where stocks will do crazy stuff after hours. Anyways, that's besides the point. We're talking about Q4 earnings.
So the first one I want to talk about is Amazon.
Mm-hmm.
Amazon, I think the headline number for Amazon was that they were going to spend $100 billion on capex next year, which is a lot of money.
Has anybody ever spent $100 billion on capex in the history of the world? It must be the highest number.
Yeah, probably.
Yeah.
They're going to spend $100 billion on capex.
Okay, so what are they spending that money on?
Most of this is in their data center and AI business. Mm-hmm. So things like a lot of this is chips to support the AI work. So if you go on like ChatGPT and you say like, what's the answer to write me an essay for like this Shakespeare work, right? Mm-hmm. Then that requires computing processing.
Yeah.
And it will go to well, ChatGPT is Microsoft,
Yeah.
but basically it goes to a data center where it consumes energy and does all the calculations to spit out that essay, and it returns that to you. And Amazon and all the other companies are spending money on capacity to be able to support this AI thing. And $100 billion, I think there's a lot of questions about what kind of returns are you ultimately going to be, is Amazon ultimately going to earn on this capex?
Yeah.
And it's not just Amazon, it's all of the big tech companies.
All the big techs, Amazon 100. We talked about this on our previous podcast.
Yeah.
Amazon 100 billion, Microsoft 80 billion, Google 75 billion, and Meta 60 to 65.
Yeah.
I'm skeptical, and we're getting off tangent again, that will be the final price tags for the year. But I think that it's better to
Right.
get in front of that.
Yeah.
Yeah.
And
It just seems like it's just an insane number, but okay.
and I think the response from Amazon was that they believe that AI inference, so which is the actual usage of the products,
Yeah.
is going to be as big as in terms of overall impact,
Yeah.
as the internet was, and as big as cloud computing as a whole was, right? So every app going forward, it's going to have AI in it.
Of course
and
it
it's
is.
going to require AI services.
So why are people so skeptical of that?
And more importantly is that Amazon thinks that on AI, they're going to make margins similar to what they earn in the core cloud business.
Which
So
is about 30%.
it depends on the depreciation estimate, but like about 30 to 40%, roughly speaking.
So for every dollar they spend, they're earning 30 to 40% or even 20%.
Right. And
It's not bad.
and then from an accounting perspective, like if you have a like if any spread that you earn on your depreciation is essentially your return on capital.
Yeah.
So they do expect really good returns on the money that they're spending.
Yes. And there's a hopeful that as these chips proliferate, the cost of buying these chips will go down.
Right.
As AI usage increases, there'll be more competition. And so the cost to build out these data centers should go down. We saw with that DeepSeek thing that maybe AI will use less energy. Right? Is that one?
Well, no.
Yeah,
So
yeah,
what Amazon
yeah.
said about, so that was a big thing because there was worries that all these companies were spending like 100 billions of capex on just as the cost was about to go down.
Yeah.
But Amazon said, well, look, like with any technological advance, like the cloud, for example, when the cost goes down, it's not that people use it just save money. They actually increase their usage of it because it becomes that much more attractive. And they expect that these type of technological advances are going to benefit their business.
Yeah.
And I think one really important point about the general capex spending for Amazon in particular is that a lot of people are making the analogy. In 1999, 2000, the tech, like the internet bubble, a lot of companies overbuilt fiber, right? The fiber networks that we are all using for the internet today. They spent maybe not 100 billions, but I don't know the exact figure.
Yeah, maybe inflation adjusted a lot of money.
Yeah, they spent a lot of money on fiber that ended up earning no returns.
No returns.
Yeah, in many cases, no returns.
Yeah.
Because it blew up.
Yeah.
And a lot of the investors in these companies lost a lot of money. And so I think a lot of skeptics would say this splurge on AI chips is essentially what's happening in 2001.
And that's fair. I mean, it's, bad stuff has happened when there's overbuilding in many sectors throughout history.
So what Amazon says is that that's a poor analogy.
Yeah.
First reason is because the amount of money that they're spending is supported by the actual demand that they're seeing. Like, customers actually do want AI services.
Not only customers, Amazon needs those services for its own network and its own logistics system, right?
And that's a theme that all of the big tech companies are.
They're spending money for themselves too, and it is going to be hard to prove the return on invested capital of that spend, but it's a necessary spend.
To your point, like a lot of like the companies are seeing efficiencies and improvements in their own business from AI.
Of course they are. Look at the margins now in Amazon retail.
Yeah.
Look at the margins increasing for all these companies. So maybe it'll be fewer employees that need to be hired as business grows. Anyway.
So that's the first aspect.
Yeah.
The second aspect is that Amazon as a whole entity, right? If you look at their retail business and you look at their cloud business today, these are extremely capital intensive businesses where if you didn't do a good job of managing the capacity relative to the demand, the economics would be really poor.
Yeah.
Like you just think about this happened to them in COVID.
Yeah.
When they didn't have enough warehouses, they built way too much of it just as demand started to fall in 22 and returns fell.
Yeah.
And
but now they're using all of it.
Yeah, now they're using all of it.
Yeah.
Which we'll talk about a little bit later. But if you extend that to their data center business, this is a really hard business to run because computing itself is generally viewed as a commodity. And what Amazon says is that they have the experience to be able to manage this kind of heavy capex spend in a balanced way to ensure that, number one, that there's enough capacity, but also that they're earning a decent return on invested capital. And I think there's no reason to think that's not going to be true.
Yeah, I think Amazon is going to be a company with $1 trillion in revenues in a few years, and we'll worry about other things aside from the capex. Most expect, Ernest, that this capex growth will decelerate heading into late 2025, early 2026, unless they come up with another better version of AI, and then they have to spend more money again. But in the meantime, the results were pretty good, right?
No, and then on the retail side, we didn't even talk about that. The retail side, they earned 8% margin, which is the highest it's ever been. And that's really due to them fixing up the way that they're distributing and shipping packages. They spent the last 3 years, the word they use is re-architected. So just changing the way that they're moving packages from the seller to the warehouse and then how they're ultimately shipping it to you. And as a result, like the cost for them to deliver packages is as low as it's ever been.
Incredible.
And the speeds are as fast as they've ever been. So, and then the other thing is, of course, that they've added a lot of things like advertising, like the third-party seller services. Like these are high margin type revenues, and that's helped to drive results as well.
Well, anecdotal at the Schwartz household, we continue to buy a lot more stuff on Amazon versus other places. It's just so much easier, and we're lazy. So anything else to add on Amazon, or you want to move on to another company?
Remember when people thought Andy Jassy wasn't it?
Andy Jassy, the CEO of Amazon after Jeff Bezos decided to go live his life on the yacht. But he's done... Yeah, you just have to be patient with CEOs. He's done a great job. The margin, Bezos never had those type of margins in retail. And Andy Jassy is like bursting at the seams talking about AI. He says it's going to be the most unbelievable opportunity. As a CEO, you have to be hyperbolic. That's just the way it is. But, if these guys are half right, we definitely want to own a lot of these big techs going forward. Company that we recently bought, Ernest, in I think October 2024, TransDigm.
Yep.
The stock price is, I don't think we made a lot of money on it. As soon as we bought it, it announced a special dividend. And that's part and parcel to TransDigm's capital allocation strategy. They expect to pay more special dividends in the future. Some worries recently about this this Elon Musk initiative to reduce the fat, the costs, the waste at spending at the U.S. government. And TransDigm was considered to be a target because it does sell a number of products to the Department of Defense,
and is known for raising prices.
But that one has nothing to do with necessarily worries about Doge, whatever you want to call it. So co-president Elon Musk so far hasn't targeted TransDigm. The U.S. military spend is probably going to continue to grow, but the bulk of its business is aftermarket parts as well as selling to Boeing. So Ernest, TransDigm just reported its results. Your thoughts on what's going on at TransDigm?
TransDigm So TransDigm is impacted by a couple of strikes. So there was a Boeing strike,
Yes.
which I think everybody
Well,
knows about.
Boeing's doing terrible, Ernest. Like they, terrible things happening to their planes, strikes, the delays.
Yeah.
The company's losing money. It's it's not
the Boeing. So the OEM side,
Yeah.
the plane manufacturing side is kind of weak, but they don't really make a lot of money there, anyways.
Yeah.
But then the commercial, the business that they make selling replacement parts to airlines, that's doing really well.
Why?
I think it's up about like I think 8-9%.
Okay.
And the reason for that is because it's related to the Boeing issues.
Yeah.
Because Boeing is not able to push out the planes, travel demand is still there.
Yeah.
People still want to fly.
100%.
And so load factors for planes, which is the percentage of the plane that's full, is at a record level. And people are flying as much as they can, and these planes are getting older and older, and they need to be replaced.
Yeah.
And so that's been kind of the driver of their replacement parts business, which is doing really well.
Awesome.
The defense business, I think, has, like, to your point, has been under a bit of spotlight lately because of their practice. Like, and there's always been a spotlight on this business because inherently it's selling to militaries, and it's a little more distasteful when you're raising prices to the government versus raising prices on commercial airlines. But I think they were very clear to emphasize that the direct impact to their business is going to be very minimal, even to the extent that anything happens, because you got to remember, most of these are essential parts that are being used to run the military. Like, the planes can't fly without these parts. And the vast majority of these parts are either sold to government, like other contractors, other militaries around the world, or are under or have like certified cost data. So to prove that they're not making
gouging or overcharging
excess margins on it. So that's really kind of the big takeaway on TransDigm.
In the meantime, I saw that their margins continue to grow. So such an excellent, well-run business. And they actually bought back some stock in the quarter. That may have given some people pause, like, oh, they're buying back stock. Why aren't they making acquisitions? Well, their stock price fell. So maybe that was a better use of their capital.
No, and TransDigm is one of those companies where buybacks are generally a good indication that they think the stock is cheap.
Because they don't really buy back a lot of stock.
No, they don't.
They don't at all. It's like they issue stock.
Right.
Yeah.
They're very opportunistic about when they're buying back stock. So take that as what it may be, but that's what
I'm taking it as a good sign.
Yep.
All right. And then the final company that just actually reported earnings this morning, it's one that a few of our clients have said, what are we doing with this stock? Because it hasn't moved. And remember, we're long-term investors. Short-term movements in stock prices don't concern us as long as the fundamentals are improving. And that's Restaurant Brands. So Tim Hortons looks pretty good. Burger King kind of flatlined, but the company's still dealing with a consumer that's just not spending as much at its stores as in the past. But all in all, the results look decent. Raises dividend 7%. Looks like it beat expectations. What are you hearing from the management?
So the overall backdrop for fast food is quite poor.
Yeah.
You've seen that from the results, like McDonald's.
McDonald's had negative comps reporting.
I mean, you also don't want like E. coli.
No, we don't. I do love the quarter pounder, but I prefer not to have the E. coli with it. So yeah.
So no, McDonald's was bad, and the convenience store players, like the low income consumer is doing quite poor in the U.S. and continues to be facing these issues.
And the inflation number out today in the U.S. just gives more pressure on these types of businesses. So,
but the big story for Restaurant Brands and why we continue to own it is because it's really a turnaround story. Mm-hmm. They had a business that had focused entirely on cutting costs before.
Yeah.
And now you have a new management in place that is like, their job is to invest in the business. They're investing in things like digital. They're making the menu like make sense, like putting offers together that make sense, like Tim Hortons, you get a $1 donut with a coffee.
Yeah.
Like these kinds of things.
That does encourage traffic to come into the store. Right?
Yeah.
And sure, I'll get a donut, and it's just pure margin for Tim Hortons.
Yeah.
Yeah.
And I think you really see that in the profits for Tim Hortons. It's up, I think, roughly 40% over the last 2 years.
Tim Hortons is an awesome business.
Right.
Wish they would spin it off. That would.
So for Burger King, it's a bit of there's a lot more things that they have to do for the turnaround. Here, the stores are old. The franchisees aren't making money. Like there's no money for them to invest in the business.
Yeah.
And so the goal here is really to remodel the stores to make them look nice and shiny so that it's a place that you want to go and eat.
Yep.
And they're kind of roughly halfway through that journey today.
By the way, that worked very well for McDonald's when they remodeled all their stores.
Yep.
It really boosted same-store sales for a number of years. Something you have to do.
To encourage franchisees to spend this money, like they put in some money themselves.
Yeah.
And they're seeing good results on uplifted stores. There's I think those that have completed the remodels are making more money than those that have not. And then there's a lot of other things like service training, improving the quality of the franchisees, like the people that are owning these stores.
You like Popeyes. You've noticed there's speed issues at Popeyes.
Yeah.
Go there and they say, "Can I have a chicken sandwich?" And they say, "Well, it'll be ready in 10 to 15 minutes." That's not acceptable at a fast food restaurant. It's got to be ready in 1 to 2 minutes.
Right. And I think all of these things that they're doing, it's really about making sure that everybody in the system is making more money. Mm-hmm. And when they're making more money, eventually they're going to open more stores, and the whole business and the brands are going to be a lot healthier.
And the extra spend that Restaurant Brands is doing on Burger King, that will go away at some point. That will be delivered back to shareholders. They're already telegraphing that by raising the dividend, keeping their long-term guidance intact. So are you going to get a Tim Hortons after this?
Well, no. So I think the stock price has been a point of frustration for myself.
Yeah.
But I think they're making all the right moves.
Yeah.
And I think that the stock market will eventually recognize it.
Beautiful. So I'll drink a double to that. Ernest, thank you for joining me today. We'll see you back here real soon. This podcast is for informational purposes only, and any forecasts on the economy, markets, or individual securities should not be viewed as investment advice, a recommendation or an offer or solicitation to buy or sell any securities. Clients of Baskin Wealth Management and the speakers on this podcast may own shares of the companies discussed. Information on this podcast is current as of the time of production and is subject to change. If you have any questions or would like to subscribe to these podcasts, visit our website at baskinwealth.com.